Okay, let's dive right into this explainer. We're going to systematically break down the biology and psychology behind a trader's absolute worst enemy, the blown account. We're talking about the destructive account draining cycle of revenge trading. Look, if you've ever found yourself throwing all your well-crafted plans completely out the window the second your screen flashes red, you are in the exact right place. We're going to structure this breakdown into tight, focused segments that you can take straight to your trading desk today, moving from the core problem all the way to some really actionable solutions. So why does a loss literally feel like a physical threat? I want you to think about that intense, heart-racing heat you feel right after a trigger loss that just seems incredibly unfair. You know the feeling, right? Maybe a sudden news event spiked the price just enough to hit your stop loss before instantly reversing. Why does it feel like a lion just walked into the room? Well, that physical sensation is your brain actively refusing to accept a financial loss, and it instantly bypasses the rational, analytical parts of your mind. Which brings us to Section 1, the revenge trading cycle. This is the core problem we're dealing with. A calculated business decision violently transforms into a personal grievance against the market. Let's walk through the steps of this very predictable pattern. First, you get the ego bruise. You feel singled out, shifting from objective analysis to taking things personally. Second, the justification. You start inventing reasons to enter a trade that absolutely do not exist in your plan just to get your money back. Third, escalation. You massively escalate your position size. You might risk 5% instead of 1% just to erase the pain in a single move. And finally, number 4, the fallout. Because the setup was completely based on emotion, you lose again, triggering a downward spiral until you blow the account. So how do we fix this? The crucial point here is that identifying this emotional state before you act is your ultimate key to long-term survival. Your actionable solution is to map your physical responses to that initial ego bruise step. The very second your ego feels attacked, you must recognize the cycle is starting so you can step back and reclaim your discipline.
Listen to this, because it's vital to understand. Bad trading isn't a lack of intelligence. It's literally a biological survival mechanism working against you. Your brain is simply not naturally wired for the financial markets. You're honestly just punishing yourself for reacting naturally to a very unnatural environment.
Let's look at Section 2, biology versus logic. Let's look under the hood at the actual science of what happens in your head the moment your P&L flashes red, and why your logical brain suddenly goes completely offline. You experience what psychologists call an amygdala hijack. The amygdala, which processes emotions and triggers your fight or flight response, goes into overdrive. That panic instantly overwhelms your prefrontal cortex. That's the area responsible for logic, planning, and your systematic strategy. In an evolutionary setting, that aggression might save your life. But at a trading desk, it absolutely destroys your capital.
To fix this, you need a hard, actionable solution. You must implement the cool down rule and force a physical break of 15 to 30 minutes. I mean it. You have to literally step away from the computer and create physical distance to reset your nervous system. You cannot outthink an amygdala hijack. You just have to wait for the chemical surge to subside so your prefrontal cortex can actually resume control. Because here's the hard takeaway. Aggression in the face of a loss won't get your money back, because the market simply does not care about your P&L. It doesn't care about your vindication, it doesn't even know you exist. Once you realize the market isn't attacking you, it becomes so much easier to stand up and just walk away.
Let's kick off this next segment with a crazy thought. Is your own brain secretly lying to your brokerage account? Even when you aren't in a full-blown amygdala hijack, your brain uses subtle mental shortcuts to convince you that revenge trading is actually a logical, smart idea. That brings us to Section 3, the 3 cognitive biases. We really need to intercept 3 specific psychological biases before they morph into revenge trading. Understanding these is how you build a mental firewall. First up is a cognitive trap known as loss aversion. That massive 2x on your screen, that represents behavioral economics, proving that the pain of losing is literally twice as powerful as the joy of gaining. This asymmetry causes you to take incredibly irrational risks just to avoid locking in a loss. It's the exact reason you find yourself nudging your stop loss further and further away, desperately hoping the market will turn around. Honestly, that is a passive but highly destructive form of revenge trading. Then we have the gambler's fallacy. This is the totally false belief that because the market has moved against you 3 times in a row, a win is somehow due. But remember this key takeaway. Every single trade is an entirely independent event. The market has zero memory of your past trades.
And that ties right into recency bias, where a recent loss makes you feel like you're on a permanent losing streak, triggering the intense urge to fight back immediately. Conversely, a recent win can lead to extreme overconfidence, which is often the precursor to a revenge trading episode, when the very next trade doesn't go your way. So how do we combat these emotional biases? You must rely on objective data and crystal clear charts. We want to take a quick second to thank TradingView for making that possible. Save $15 using our referral link in the description to get the standard and charting. Grounding yourself in hard, undeniable data is a phenomenal way to shut down those cognitive biases before they start. Moving into our next focus, the core premise here is simple. When emotions are high, you have to remove the choice. When you are under severe stress, willpower alone is going to completely fail you. You simply cannot rely on your mind to protect your money when your mind is the very thing being hijacked. Which leads us perfectly into Section 4, Mechanical Risk Management. This is where we implement hard mechanical internal controls that act as literal guardrails against your own worst instincts. We're going to remove the element of choice entirely. You must hard code a daily loss limit into your platform, say a 3% total drawdown. So when you hit it, your platform locks and you literally cannot trade. Next, enforce strict position size standardization, so you stick to your contract sizing regardless of whether you're up or down. And finally, utilize a pre- and post-trade journal to spot these toxic emotional patterns before they escalate. Look, the absolute most critical, disciplined scaling rule you can take away from this entire explainer is this. Never, ever increase your position size to recover a loss. Changing your contract sizing based on a previous red trade is the fastest possible way to hit mathematical drawdown hurdles that you simply cannot recover from. Standardize your size and protect your capital at all costs. For our final segment, I want you to consider a massive psychological shift. What if losing money was just a normal business expense? Think about how reframing a loss changes your entire biological response. If you change the meaning of the loss, you completely short-circuit that amygdala hijack. Let's dive into Section 5, Reframing the Cost of Business. Professional traders view a stop loss simply as the overhead required to run their business, much like a store owner paying the electricity bill. A retail store owner doesn't get furious at the power company, right? They understand it's a built-in statistical probability of running a business. So, if you slip up and catch yourself right in the middle of a revenge trade, the only actionable solution is to close the compromised trade immediately, regardless of price. Do not wait for it to get back to break even. Because that trade was entered under a compromised mental state, it has absolutely no place in a professional plan. Closing it isn't taking a loss. It's an act of reclaiming your discipline. For additional solutions and to really master these mechanical rules, contract sizing, and disciplined scaling strategies, make sure to purchase a copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. It is packed with the structural guardrails you absolutely need to move beyond the beginner phase of retail trading. So, as we wrap up this explainer, I want to leave you with one final thought. Ask yourself this vital question before you sit down for your very next session. Are you trading the market, or are you just fighting yourself? Use these biological insights, lock in those mechanical loss limits, and stay disciplined out there. See you next time.